Listen-only mode.
Good afternoon and welcome to the webinar hosted by the IRRC Institute on new research from EY, the Corporate Risk Disclosure Landscape. Our agenda today is introductions, an in-depth review of the research, some words from the IRRC Institute on their perspective on the research, and then we'll take your questions. In terms of logistics for the webinar, please know that all the attendees are in listen-only mode, but your questions are encouraged. Throughout the webinar, you can type any questions you have in the question function in your control panel. After the presentation, we will read the questions out loud and the speakers will respond to your questions. Following this webinar, you'll receive an email with a link to a replay of this webinar, and we'll also send you a link to download this PowerPoint presentation. This report and all our other reports are available at www.irrcinstitute.org. We encourage you to share any information on social media about this report. Our Twitter handles are listed there. And if you have any audio issues during the webinar, please contact GoToWebinar at 1-800-263-6317. Please also know that we are recording this webinar at this time. Our speakers today are Kelly Hunnekens, the EY Center for Board Matters, and Dan Helwing, her colleague at EY, and he's in the SEC Regulatory Matters practice. Both Kelly and Dan are the principal researchers for this report. Also on the webinar today is John Lekumnik. He's the Executive Director of the IRRC Institute. John's been in that position since 2008, since the beginning, and with the board, he leads the organization to become it's now a leading source of objective and academic practitioner research on a wide range of investment issues. Just a couple more words about the Institute. As I said before, John has been on board since 2008. It was established in 2005. The purpose of the organization is to fund, disseminate unbiased research on investor issues. It's both academic and practitioner research. We have an annual research award each year with two $10,000 awards, and we just announced those winners last December. And there are more than 40 research reports available at no charge to you if you want to visit the website on a broad range of issues, everything from environmental issues to corporate governance issues, executive compensation, just a whole broad range of issues, and we encourage you to take a look at that. And with that, I will turn the presentation over to Kelly, and she will run through the presentation. Kelly?
Thank you, Kelly. Dan and I are very pleased to be here and to have the opportunity to work with IRRCi on this very important project. Let's open the conversation with a look at our approach and methodology. Kelly, would you mind moving to the next slide? Thanks. The study covers risk factor disclosures, and for those who may be less familiar, these disclosures are located at the beginning of the Form 10-K. They're listed as Item 1A and located just after Item 1, the company's description of its business. We reviewed the risk factor disclosures of 50 large companies, representing the 5 largest in each of the 10 sectors, and in aggregate, they represent about $8 trillion in market cap. What we did for the study was we took each company's individual risk factors and assigned them to a risk factor category, and this was intended to provide for a common basis for analysis. We then supplemented this approach with a word search to tease out more detail. We also evaluated each risk factor through 4 different perspectives as part of our efforts to look for language that might be indicative of more meaningful disclosure. Before we start, I'd also like to share some caveats to the research, the first being the limited size of the data set. This review was also limited to the risk factor section, so exclusively to Item 1A. Also, the approach of using categories may cause some in the audience to infer that some topics may not have been discussed within the risk factor disclosures when they may have been referenced, if only slightly. All right, next slide, please. All right, moving on to key findings. First, we found that about 65% of the time, companies are generally not using specific language unless further information is already available elsewhere in the 10-K. Second, We found that the disclosures are long. They average about 6,000 words just for that section alone. This suggests to us that companies with lower risk profiles may have an opportunity to reduce the extent and the number of risk factors discussed. Third, companies commonly cited competition, global markets, and regulatory matters, but often generically, meaning it was hard to distinguish at times between companies and sectors, because much of the language was generally applicable to all. Fourth, when the companies discussed risk mitigation efforts or changes in the nature of the risk, we found that the disclosures tended to be minimal and generally overshadowed by the prevalence of vague generic language. Looking at the last two of the key findings, we found that the risk factor disclosures may serve as an indicator of what a broad base of companies may view as emerging risks. Most prominently, we can look at cyber and climate change. And last, we found that cybersecurity in particular was an area where companies appear to have responded more to stakeholder concerns about the extent and effects and management of cyber-related risks. There were significant differences in terms of the disclosures around cyber relative to other risks. Now, for a discussion of drivers behind this project, I'll turn things over to Dan.
All right, thank you, Kelly, and welcome everyone. I thought I'd start and just maybe take one step back and focus on the requirements for risk factor disclosures and then also some of the background that led up to this project. So if we think about the SEC rules, they call for a discussion of what makes a company or an offering risky. And so that's very, very straightforward. It generally entails areas related to a company's results, operations, their history, financial condition. But what's important about those requirements is the information has to be company specific. It should be clear, concise, organized logically in a manner that includes subcaptions that adequately explains what that risk actually entails. And then we can all laugh about it as well, but there is a requirement here that we use plain English to explain those risk factors. So if we go on to the next slide and we think about, as we were embarking on this project here, what were we thinking about in framing some of the work that we were doing? And a lot of this came about through disclosure effectiveness, where we've heard a lot in the last year and a half about disclosure effectiveness as a priority of the SEC. I'd say just yesterday as well, the SEC chair, Mary Jo White, was discussing this as a priority. She was explaining that in the short term, we can expect to see a concept release on Regulation SK, which is the broader set of disclosure rules that includes risk factors, as well as a number of other areas, MD&A. You can probably expect to see more along the lines of cybersecurity and climate change as well. And then at the same time, the SEC and the staff has been encouraging companies through a call to action to improve their disclosures. In the absence of any rule changes, I think we can all agree that there's a lot of different ways that we can write better, that we can improve the disclosures and information provided to a user, and we can think about some of the suggestions and recommendations out there. So as we start to think about risk factor disclosures, that was one where, as we were reaching out to different constituents and stakeholders about areas to improve disclosures, a lot of what we would hear was risk factor disclosures are extraordinarily important to the document. If we could only make more sense of that information. It's very dense, it's very compliance driven, and are there other ways that we can prioritize the information? Can we change the organization? Can we include the more important risks first? Can we even, I think we heard some suggestions about limits on the number of words or risk factors, and that's probably unrealistic, but the focus being how can we focus on what is most meaningful? And then the other idea that was coming up was to think more about the elements and components of the risk factor disclosures. What are we seeing there? Is there more discussion about company-specific details or how risk can affect a company? And so as we were designing this project, we couldn't capture all the subjectivity here. I think we can all have different views about what is good, what is bad, what is effective, what is ineffective disclosure. But what we wanted to do was at least objectively measure what are some of the elements of risk factor disclosure, and did we see them or did we not? And so if we get into some of the details, and let's move on to the next slide, we started at a high level. Just by the numbers, as we look at the landscape of risk factor disclosures, how much is devoted to a risk factor discussion? And as Kelly mentioned before, we were only focused on the one section of the filing that pertained to risk factors. There are other places throughout a document where risk comes up, but we wanted to focus on that particular section, and we found that on average about 7% of the document related to risk factors, so it wasn't a small portion, about 8 to 9 pages, and the number of risk factors that were listed was in the mid-20s. What was most interesting was the dispersion between companies and even within industries. We saw more consistency within an industry, but there was still a wide range of results. In some cases, there were as few as 5 to 10 different risk factors. Others, companies had a fairly long list and very lengthy disclosures of 40 to even 50 as far as the number of risk factors listed. So from there, we wanted to focus more on where is a company focusing its attention? What types of risk factors? And so if you go on to the next slide, we identified 17 risk factor categories, and this was really trial by error, going through the different filings and bucketing what is the primary theme of the risk factor, and then how does this roll up into similar categories. And so we've listed this on the slide. You can see a lot of those are more macro level type risks, those pertaining to regulation, the government, capital markets, and economic conditions. There are others that are more micro level, still probably applicable to a broad range of companies, but those such as personnel, litigation, governance matters. So from there, let me turn it back over to Kelly if you could walk us through some of the key themes and observations we had from those categories.
All right. Thanks, Dan. Well, looking at companies provided risk factor disclosures shows that certain categories or types of disclosures appear to be relatively standard, and we define that as being where 70% or more of the companies provided disclosures in these areas. As you can see from this left-hand side of the slide, most of the risk factors represent long-standing topics with the exception of cyber. For the less common risk factors, we've defined those as being disclosed by less than 30% of the companies that we reviewed. These themes, again, are based on an overview, a review of all the companies, and of course sector-specific themes are evident as well. Kelly, can you help us turn to the next slide? Thanks. Now, the sectors, certain sectors tend to disclose certain types of risks. And just to throw in a couple examples, you'll see that consumer-facing sectors such as consumer staples or financial services, technology even, they tend to disclose more about company reputation, use that as a risk factor. In telecommunications, you see risk factors related to the competitive landscape, more so than you could say energy. It's just a couple examples there. What we also saw was that there was a difference in terms of how concentrated or dispersed the risk factors were. As an example, 3 risk factor categories alone represented almost 80% of the risk factor disclosures for financial services, and you see that here. And in comparison, looking at consumer staples, it's just 4 risk factor categories, sum up to less than 50% of the different risk factors disclosed. During our study, we also found that in some cases, companies appear to be benchmarking their disclosures against peers, which at least we found interesting to note. All right, next slide. Thank you. Here we switched to the word search approach. We did this basically to gain greater visibility into certain hot button topics. As you can guess, the category approach, the large 17 buckets, includes a lot of different, more nuanced elements within that. So as part of our search, we found that even though about 80% of the companies featured cybersecurity as a risk factor, and this is the prominent category that Dan introduced earlier. Discussions and references to cybersecurity was prevalent. 96% of the companies had some discussion or reference to the terms cyber, data security, privacy, things like that. Similarly, albeit on a different scale, we saw that about 20% of the companies showcased company reputation as being a risk factor topic. But company reputation, image, that type of language was found, again, throughout many, many more companies, and we summed that up to 84%. Interestingly, 62% of the companies featured natural and human disruptions as a risk factor, but it was only a little over half, 54%, that specifically referenced climate change. And I'd like to note here that the use of the words may be in connection with other developments and not necessarily reflect a company's level of attention or views on a specific topic. And using climate change as an example, in some cases the reference to, or the use of the term climate change was in reference to a discussion of the regulatory challenges that the company faces. So, right. Now, focusing on our review of the disclosure language, basically we looked at disclosure language from 4 perspectives to try to tease out more meaning and impact. So starting off with the effect of risk on the company, this was the most common type of disclosure language that we found. And examples of this may include how changes in domestic or global tax policies may affect the profitability of a company or even corporate expansion plans. And in another example, a company may disclose how there may be a decline in sales related to increased competition, whether it's from comparable products in the marketplace, direct competition, or generics as patents are expiring, or even counterfeit goods. We found that certain categories are less likely to include a discussion of the risk effects, and perhaps not surprisingly, those include litigation, changes in key personnel, and capital markets related risks. We also saw, as we were looking at this effective risk on the company, that bucket, so to speak, we also found that there was a lot of lists. There were a lot of companies, in many cases, use a list approach to define what was within a specific topic, a specific risk factor. For example, a company, rather than tying in disclosure of how capital markets and economic risks might tie to the company, they might spend the disclosure language focusing on listing what these risks included, to include interest rate risk or employment trends and developments, consumer spending habits, things like that. Next slide, please. We also looked at specificity. And here what we looked for were numbers. We looked for percentages, proportions. We also looked for use of proper names and company-specific developments. Examples include how a change in credit rating may affect a company's interest and debt exposures. We also found references to company offices or plants being located in earthquake zones or areas vulnerable to flooding, and just as examples of specificity. All right. The next slide takes us into examples of language on risk management or risk mitigation efforts. We tended to find this in connection with high-profile risks such as cyber. But we also tended to find this in cases where there were tools to address this in the market, for example, insurance or derivative contracts and things like that, and where diversification was an option. some companies may disclose that as an approach that they were taking to help address this risk. Less common areas for this include, and perhaps not unexpectedly, company reputation or counterparty risk. So looking at the company reputation as an example, you might see companies provide disclosures about their corporate responsibility efforts, or there might be language about how they're directing branding and marketing efforts towards improving customer loyalty. With regards to counterparty risk, examples of the mitigation language would include things like, that the company is monitoring the financial condition of key customers and suppliers and so forth. Right, then, perfect. This next slide, risk factor trends. This was our last approach to analyzing the disclosure language, and it refers to changes in the nature, the intensity, and the likelihood of a particular risk. And there were several common themes that emerged in our review. Perhaps most prominently was discussions of how the changing technological landscape was affecting company business models. There was quite a bit of disclosure about how there was an increase frequency, sophistication, and also in terms of severity of cyber attacks, including looking forward. There were a number of companies which anticipated that this would be an even bigger risk going forward. We saw discussions of how it appeared to be increased trends for more competition, greater costs, litigation, and a challenge of more regulatory complexity going forward. All right, and then to wrap things up, I'll send this back over to Dan.
Thanks, Kelly. So if we go to slide 21 here, this is a summary of our results for those 4 key components that we want to look at in the language. And so the first that Kelly had walked through, the effect on the company, that's where we saw it most often. So 91% of risk factors that we reviewed had some discussion on how that risk affected the company. Now, we weren't measuring the quality and we weren't measuring the number of words associated to it, but in any case, we saw that in most cases there was some discussion on the effect on the company. The other elements we saw far less frequently, and so specificity and using those types of specific terms, that was only appearing in about 1/3 of companies. And then the other 2 as well were more around 20%. So the risk mitigation efforts, what is a company doing to address this risk? We saw it very infrequently, only 20%. And then trend information, as far as what's changing, is there a risk that's becoming more of a priority or higher risk or more material? That was even the lowest amount of our results here at 19%. So that leads us on to the next slide here about some of our overall observations. And as we started this analysis, we were focused on the different elements of the categories, the types of risk factor categories we were seeing, and then the elements of the disclosure language itself. And some of the observations we had, and as we walked through on the previous slide, was that these key areas where we've heard that users want to see more, and arguably within the requirements itself that call for company-specific information, we were not always seeing some of those types of elements. We weren't seeing a lot of the company-specific type details, the types of efforts that companies were performing to address that risk, or what else has been changing in that risk factor. And so on the next slide as well, as we think more holistically about companies and their disclosure efforts, we started off by talking about disclosure effectiveness and how there was a push to have an ongoing and iterative process here to improve disclosures. And I think risk factors is one of those areas that can be fully embedded within that process. And what has worked very effectively for companies that have started that process is to reach out to all stakeholders to understand what they want to see what we could do better, and start to build that into our approach and make that a continuous area of improvement into our disclosure documents. So with that, I'll turn it over to John if you want to take us through some of your takeaways and observations.
Thanks, Dan. First, I do want to thank Dan and Kelly and Ann Yerger and the rest of the EY team. Those of you familiar with IRRCi research know this is the sort of thing we tend to specialize in. I'll call it an Emperor's New Clothes report, something that everyone knew or suspected but had never been sufficiently objectively and comprehensively documented before. And I think that is perhaps the most important part of this report. The various advocates for disclosure effectiveness can now take this and start their discussion from an elevated fact base, and that is always useful. EY is obviously beyond reproach in being objective and saying things could be improved or things are generic. I would say that the disclosure effectiveness, and this is my opinion, not theirs, leaves much to be desired for reasons we'll see on the next slide. You know, why do investors care about disclosure? And there are many reasons, obviously, but there are two that to me are the big ones. First, what are the specific risks to the company? To say that there is regulatory risk in the financial sector or reputational risk in the consumer sector or competition everywhere is, you know, not brilliant analysis, and it doesn't really add anything to anyone's knowledge of the specific company. So you want to know what are the specific risks to the company. And the second, which gets to that mitigation aspect, is the board performing its risk oversight role. Let's be very frank. Risk is at the heart of capitalism. You cannot make money without taking risks. The idea is to take intelligent risks and to mitigate them where possible to the extent that the board has chosen for what's an appropriate risk appetite for that company. And so you want to know that not only is the board aware of risks, which gets to what Kelly was saying about the laundry lists that tend to appear, but they have some sense of what's important to the company, which is the specificity, and that they are making sure that management has a process to keep the risks within the lineup and the dimensions that the board has chosen, which gets to the board's oversight role. And I would argue that the current state of risk disclosure fails on both counts. If only 35% of companies cite company-specific risks, that's a problem because it doesn't give you enough information. If only 20% disclose mitigation, it is hard to say if the board is providing its risk oversight role for the other 80%. Now, let me be clear. I fully believe that the vast majority of boards are performing their risk oversight role. I know from speaking to innumerable directors that audit committees get risk dashboards, that they spend an awful lot of time doing this. But that is not the same as some level of disclosure to investors, regulators, other stakeholders as to what that looks like. Next slide, please. So that leads us to, as Dan and Kelly said, many opportunities for improvement. You can better inform investors by being specific, ordering your lists, your risks by priority. Again, audit committees do this with a risk dashboard. They do not, believe me, at every audit meeting go through 40 or 50 risks. They focus on the key ones to the company. Disclose trend information. As the report shows, it's only in 19% of disclosures today. In terms of demonstrating that the board is doing what it is supposed to do, cite the board oversight. You can cite your process. You can cite the periodicity of review. Do you look at risks every audit committee meeting? Do you do an annual update? None of that and even substance, such as around cyber now, can be done without disclosing proprietary information. No one wants a list of proprietary risk mitigation measures, particularly in some areas such as cyber. It provides a roadmap to bad guys. But we want enough information to know that the board has a process and what the periodicity and the depth of that process is to oversee what management is doing to mitigate the risks and to make sure the risks are consistent with the risk appetite that the board has chosen. And finally, as an enabling aspect, I want to mention that risk disclosure is also burdensome on the company the way it is now. It is a compliance exercise. There's a lot of compliance language in there. If you think about it as a communications exercise, yes, you have to meet the SEC requirements that Dan said, but there's nothing in there that says you can't shorten the boilerplate and focus disclosure on what matters. That would reduce the compliance burden. It would be more intelligent, it would be shorter, it would be more specific, and it would be more of what investors are looking for. And with that, Kelly, let me turn it over to you for questions from the audience. Thank you.
Terrific. Thanks, everyone. We're now moving on to the Q&A portion of the webinar. Just as a reminder, to ask a question, you should have a question box in your control panel. Just type your question in, we'll read it aloud, and then Kelly, Dan, or John will take a stab at responding to your question. Okay. Just first of all, as one comment, slide 21 is a brilliant slide. This looks like a call to action for public issuers, just a comment there. Our first question, how do you balance the need for sound/rigorous risk disclosure against the need to protect proprietary strategic mitigations underway that create a competitive advantage?
I'll take the first crack at that. I think I answered that. If you say, let's take cyber as an example, since it's what people do best now. If you say the Chief Information Security Officer, what the reporting line of that is, that there is a cybersecurity plan, that what framework you use, whether it's the NIST framework or others, that the board reviews it and the attempted and completed penetrations, and that we do that quarterly, that you have policies in place for physical information security as well, and that internal audit reviews those on a risk adjusted, on a risk basis, basically the frequency of the various aspects being determined by the risk disclosed. That's a pretty fulsome disclosure. It doesn't reveal a single thing about what the nature of your passwords is, about what the nature of your security, your firewalls, your segregation of servers, none of that. And so it is largely a process disclosure, and you can also say, it deals with the mitigation, and you can add in trending, such as we have tracked an increase in penetration attempts or a decrease, and we're getting more or less effective in certain areas. You can provide a lot of disclosure without providing proprietary information.
Thank you. Our next question, what sort of language filters were used to identify trend disclosures? Do you want to take that, Kelly or Dan?
Sure, happy to. For trend disclosures, we cast as broad a net as we could. So we literally looked for language referring to the change in intensity. Is something getting worse? Is it something becoming more challenging or less so, fading away? Frequency, the nature of the, for some companies they would have disclosure that said cybersecurity wasn't, a real issue, well, not in these words clearly, but was not a real issue, say, a decade ago. But that is something that's become more real, and it's something that the company is positioning itself to better address. That is an example. So it wasn't it wasn't just looking at terms, it was also reviewing carefully because the types of the words that were used by companies varied quite a bit. So this was not a this disclosure review was done by hand. So does that answer the question? Well,
I think so.
Yep. Let me add one thing. Kelly had a caveat at the beginning about the size of the universe. These were the 5 largest company in the 10 GICS codes, as she said, with $8 trillion in market capitalization. That was done partially to enable EY to do that hand search and to be really in depth. The other thing, although it is an assumption, I think it is a reasonable assumption, that since these are the largest companies in those sectors, they probably have the most sophisticated disclosure regimens on average. Now, clearly there are outliers among the smaller cap companies, and probably there's no such thing as an underlier, but outliers negatively in this larger cap company. But on average, I think it's rational to assume that this is sort of the state of disclosure for large cap companies, and that small cap companies are not as sophisticated in disclosure. So in some ways, this is the creme de la creme, and the limited number of companies also allowed EY to do that hand collation.
Thank you. Our next question. So I understand you looked at the top 5 companies in each sector. In some sectors, some of these companies file Form 20Fs and not 10Ks. Did you analyze the 20Fs at all? Sometimes disclosure by foreign U.S. listed companies is better. Want to take that?
Yeah, and this is Dan. Just to address that question, no, we were only focused on the Form 10Ks. We did not review any of the filings specific to foreign private issuers. So to look at the top 5 companies, we were looking at the top 5 that were filing 10Ks.
Thank you. Our next question. What about the legal barriers and incentives? Surely the vaguer the language, the easier for the company's lawyers to defend non-compliance.
I think the question has its answer in it. If you think that is a positive for capital markets, I will just disagree.
Our next question. Can you please discuss environmental risk disclosure a little bit more detail in terms of your observations there? Did any sectors or risks stand out in particular?
That's pretty broad, and I'm happy to. My contact information is at the end of the presentation. I'm happy to discuss in more detail offline. I thought that the climate change related disclosures were really fascinating. Some companies, for example, would discuss how the impact of climate change may affect not just their production process components. It depends on what the company was making, what services they were providing, of course. But basically, it looked at the effect of climate change on the company business. In other cases, you'd see references to climate change. I mean, really, just in terms of regulatory developments maybe coming our way, looking at this market or that market. We're expecting that these regulatory changes will be what will be impacting our profitability and our business. So personally, I found that really, really interesting. And again, happy to discuss more offline.
Thank you. The next question. Did you also look at any other corporate documentation such as non-financial CSR/sustainability reporting?
No, we didn't. And clearly, I mean, companies will disclose different things in different vehicles, so that was certainly a limitation of this review. We focused the study on just item 1A.
Thank you. Our next question. Can you clarify what you mean by disclosure effectiveness?
Yeah, and I can take that one, and that's been, such a recent focus here, and it started out as an initiative to think about obsolete information, redundancies, but ultimately the goal here is just to improve disclosures, to make them more meaningful to users. And that's how the SEC has started to think about that when they've been talking about a disclosure effectiveness initiative. Is there's a few components of this where our rules are old. In some cases, they're obsolete. We need to modernize them, and we need to look at areas where there are redundancies, where we can eliminate some of the disclosure requirements that aren't applicable, but more importantly, focused on some of the disclosure requirements that just aren't there, that could be improved to make it better all around.
Thank you. Our next question, is there a list of companies that were included in the study?
No, we did not provide a list, and basically it was just the largest companies by market cap as of, let's see, the end of January in 2015, based on the most recently available filings.
Okay, our next question. What trends are you seeing in disclosure effectiveness?
Yeah, and I can take that one as well. I mean, just to focus on disclosure effectiveness, to follow up on that point, because it is an interesting area as far as what we've been seeing from companies. In a recent survey, we saw that about 75% of companies had been addressing disclosure effectiveness, had some sort of initiative in place to improve their disclosures. I'd say a lot of what we've seen recently has been more about the look and feel of those documents, using tables and charts to make it more user-friendly. I think the next stage is to really hone in on some of the sections. I think there have been some that companies start with one section at a time, as far as a business section or MD&A. What we haven't seen is a lot of focus on this risk factor section.
And if I could just add something, I think that what this report does is set the stage for that next step. There are innumerable groups, from the National Association of Corporate Directors to the Sustainability Accounting Standards Board, to, as Dan said, there probably will be a concept release from the SEC looking at disclosure effectiveness, including risk disclosures. And our hope is that by having this research, which is fiercely non-advocacy, and as Dan and Kelly said, just sort of a review of what is, that it can inform that discussion in whichever direction that those groups want to take it, but so that we're all starting from a common base of what actually is.
Thank you. Our next question. You know that these disclosures are very important part of our work in analyzing companies, but having been on the other side considering what to disclose, what might seem like an innocuous disclosure to most investors can tell competitors who have more intimate knowledge of how the business operates, what you're likely doing. How would you feel about private disclosures to existing shareholders who sign confidentiality agreements? Anyone want to take that one?
I've been on both sides of this too. I think that yes, there are limits to disclosure. You do not, as I said, you do not want to reveal material proprietary information. But I do think there is room for improvement in public disclosure. Right now, on NDAs, on confis, and you'd also have to have standstills, because if it's material and you're doing a private disclosure, they can't trade on it. So I don't know how many investors would want to take that deal. But you can do whatever you want in a private agreement as long as you obey the SEC rules and the laws. So I have been involved in some activist situations where exactly that sort of discussion has taken place, and there have been confis and standstills. That, I think, is a narrow solution and does not improve the overall effectiveness of disclosure as this report is looking at it.
Thank you. Our next question. Are you aware of any cases of SEC enforcement against companies with insufficient disclosure?
Yeah, and I'm not sure exactly how to answer that question. You know, I mean, it's specific to what types of disclosures. I mean, certainly there have been enforcement actions for misleading, false, fraudulent type disclosures.
And there's also, I think, currently hasn't, and Dan, you may know this, and I apologize, we're getting beyond the scope of the report, but I think the New York Attorney General has said that they are examining at least one company for climate change issues, and clearly there was a major state AG settlement to tobacco companies for non-disclosure a number of years ago. So it's not just the SEC, right? I mean, there are state laws as well, but it really depends on the nature of the disclosure and who the enforcement body is.
Thank you. Our next question. Do you have any views on disclosing so-called ESG risks separately in a CSR type report?
I think that's, as I said, this report is the state of the current market. Where disclosures are made actually is a relevant question because there are different auditing standards, for instance, if something is included. I would also note in terms of ESG that there are an increasing number of stock exchanges around the world that require it as a listing standard issue. So that is not to say the U.S. does, although certainly subtypes of disclosures from conflict materials to climate change if material are required. The climate change, not specifically, but de facto, as evidenced by the number of companies doing it. So I'm not going to give an opinion as to how it should be disclosed. What I will say, though, is that where something is disclosed has an effect on the level of assurance of the disclosure and on the impact of lack of disclosure.
Thank you. Our next question. You mentioned reputational and human disruptions. Did you see anything mentioning labor risks or human rights risks in the disclosures?
Yes, I certainly did see that. Those we folded under the category of human capital. And if you, not to turn this into a pitch, but it's just easier to reference that way. If you're looking through the report, and you'll see how the companies, either the sectors, kick out in terms of the human capital factor.
Terrific. Our next question. Why do you think the quality of disclosure around cyber is different?
I'll give this a shot. I think it's partly because cyber-related risk both is in headline news, and it's also an extremely personal risk for a wide range of stakeholders. And I suspect that a lot of companies are getting asked a lot of questions about data security, information privacy, and what kind of processes they have in place. Not only whether, I think it's occurring whether or not they're in the news for a cyber attack. I think if any company is in the news, I think a stakeholder is more likely to raise that question, those questions to their own companies. And I think overall it appears that for a number of companies, cybersecurity represents to them a clear and present business risk.
Thank you. And it looks like we have gone through all of the questions. We had quite a few there. So thanks everyone for the wonderful questions. This concludes our webinar for today, and we thank everyone for your attention. Again, a replay of this webinar will be posted on the IRRC website along with these PowerPoint slides by tomorrow. If you have any follow-up questions, John, Kelly, and Dan, of course, are available to respond to any questions you have. Their contact information is here. So again, we thank you for your participation, and we look forward to seeing you on our next webinar. Thank you, and have a wonderful afternoon.